All right, let's go ahead and get started. Other people will come in and we'll answer their questions if they have any, but thank you for joining. My name is Shane. I run the events for 10 Capital Network, and today we are very glad to have Paul Foley of Smart Capital come to talk with Hall about how to use syndication platforms to raise funding. And with that, I'll give it to Hall and you guys can get going.
Thanks, Shane. Thank you guys for joining with us today. Today, we're going to talk about how to raise funding using a syndication platform. And we have with us the founder of SmartCapitalX platform, Paul Foley. Paul, thank you for joining us. Can you tell us a little bit about yourself and your company?
Absolutely. Well, first of all, thanks for having me. And then Shane, that was great intro music. So I'm going to have to use that next time I do a Zoom call like this. So I'm Paul. We started Smart Capital. We basically target investment groups and fund managers who have investor networks that want to syndicate or pull investment together from that network to invest in startups. The platform went live, so other basically groups can use it this year. We initially built it for our own group, Denver Angels, which we've been running for the last 2.5-ish years here in Denver, Colorado. And I'm excited to be on today, tell you more about the platform as well as syndication in general.
Great. Well, can you kick off? And for those who are not familiar with syndication, can you talk about what that is and how that works?
Sure. So the definition of a syndicate is basically a group of individuals or a group of groups that come together for a common purpose or common interest. In the case of startups, the basic idea of a syndication is to pull investment from multiple investors into one LLC and then invest into the startup. So here in Denver, for example, there's around 300 investors that want to invest into early stage startups. Instead of investing as individuals, what we do is we believe as a group we're more powerful and we make better decisions, as well as we can invest more. And so whenever we make an investment decision, we pull investors into these LLCs, and the check sizes for each individual investors ranges anywhere from $5,000 to $100,000 as individuals. We pull all that money and then we go and invest in the company. And the check sizes for Denver Angels has been $500K to $1 million. The other groups that are on the platform are doing something similar. It ranges from investment groups that are 10, 20 people that are just close friends to other more professionally run investment groups. So
syndication is growing. Why is it growing? Why are people turning to syndicate platforms and syndication mechanisms?
Sure. So the amount of investment that's just going into early stage startups has grown tremendously. Also, for the first time, not first time, but at a much higher rate than normal, individuals actually want to get involved in investing in early stage startups. For basically, it's kind of really taken off in the last 5 years. But before that, if you wanted to invest in VC, you would either invest into a venture capital fund, which would have managers that would invest through the fund, or you would just basically invest in your friends and family's deals. I think a lot of people now, as individuals, instead of just investing in public stocks or real estate, also want to invest into startups. And so the best way to do that is through groups and group funding.
Great. So how should a startup founder use or take advantage of syndication for their deal or their fundraise?
Yeah, so it's very common for founders when they're raising their seed round or seed plus round, and even their Series A rounds, to be going and talking to individual angel after angel after angel. What's great about these investment groups is instead of having to have 200 coffees with a bunch of different individual investors, if you can find an organized group or community, then instead of having to have multiple conversations with tons of different individuals, you can have kind of conversations with decision makers or the group all at once, and then the group can make an investment decision. What's great about that too is it saves you time and also will probably get you more money. So as a founder, you can seek out these investment groups. They usually are geographical. So like the example I gave earlier, Denver Angels, but you also see tons of investment groups that invest in anything from life science companies to fintech companies across the board. So.
Great. Can you contrast and compare it to, say, a crowdfunding raise or an equity crowdfunding raise? What is it similar to, and what is it different from?
Sure. So for non-accredited crowdfunding, so basically using a crowdfunding platform. So those platforms are going to basically, take in money from anywhere. So you can think about it as like the general, greater US. Those basically platforms are usually pretty good. I would recommend them if you want to get funding with new customers. So I think it's really good for consumer-based products that want to highlight what they're doing and get new customers as well as investment. The difference I would say between a syndication or an investment group and the crowdfunding platform is the investment groups are going to be accredited investors on it usually. And also they're going to be, instead of blasting the thousands of people on these crowdfunding platforms, they're going to be more specialized and also a smaller number. So you're really only going to, each syndication of an investment group, even though the group might have 200-ish people, the actual amount that will invest in your company will range between 10 and probably 50 investors. And so it's slightly different. The crowdfunding platforms, if you're an investor and you're looking to invest, are also, there's a lot more fees. So basically, if you're an investor going through a crowdfunding platform to invest in the startup, they're going to charge you a lot more fees in terms of basically straight off the top, as well as potentially carry.
So syndication platforms use a SPV or special purpose vehicle structure. Can you describe how that works and what the structure entails, and what do you have to do to maintain that structure, and how do you do the funds administration and those type of things with it?
Sure. So every time investors are going to go and create what basically you can think of them as like a mini fund. And so what happens is you basically create an LLC entity. There's a one-time basically cap call. So all the investors will pull money into that LLC for this one-time investment fund. The investment fund will basically sit there for the sole purpose, or special purpose is why it's called an SPV, but the special purpose of investing in this company. And then it'll basically sit there until there's distribution. So the funding goes into the company, and then the company, chugs along, hopefully grows, exits. Then there's going to be a distribution back to the investors after a certain period of time. That could be, 1 to 20 years. It just depends. But you're basically creating these LLC entities that are just standalone every time you do one of these deals.
And what about the legal requirements and the tax reporting and so forth? What's involved there?
Sure. So when you do these, you do have to file an initial tax return. So basically, when you go ahead and you create the LLC and the funding goes in there, you have to say how much you have to do a Form D for regulatory filings, and then you have to file a tax return which says how much was raised, and then the capital accounts, as well as there is usually a service fee. Smart Capital charges a service fee, as well as the other kind of SPV platforms. So you go ahead and you file the tax return based on that. Afterwards, depending on the investment, a lot of times the LLC can sit there, and you don't actually have to file a tax return for an LLC that doesn't gain anything. So basically, if it's losing money or if it's zero, right, you don't actually have to file tax returns for LLC specifically. So usually it's a $0 gain each year until the company eventually exits. At which point you then have to file another tax return with all the gains that you've done accumulated over the years. And so at that point you have to do another tax filing. You have to do distributions to the investors based on their capital holdings in the LLC, and then you have to wind down the entity. So then you have to do a report basically saying that the entity is now dissolving.
Great. Can you talk about the element of carry? I used to run angel networks that used a network model. Everybody wrote their own check for what they wanted to write it for. A little bit of a challenge to gather all the checks and the funds that came in, but once you had it, you had it. And then came the age of syndication, where somebody would lead the deal. They would actually do the diligence, gather it all up, put the initial money in, and then they would put that out to a syndication platform like yours, and they would charge a carry on it. Can you talk about how that works?
Sure. So carry is basically a fund model, and it's used across real estate, private equity, VC funds, as well as in these kind of one-time syndications. And the idea is it's a percentage of profit that goes to managers. And it's a way to align compensation to the managers based on how well the investment performs. So a lot of early stage investment, basically firms, whether it's an actual VC fund or a manager using a syndication model, will basically charge a carry. And these carries, the average is 20%. So that's the kind of standard, but it will range based on the fund manager. And the compensation will be to the fund manager on the profits. So let's say, a fund manager invests $1 million into a startup, and then the startup does really well and returns $10 million back to the fund manager and the investors, right? So you made $9 million of profit after you return the first $1 million back to the investors. Of that profit of $9 million, depending on what the carry is, so for this example of 20%, 1.8 million of that would technically go to the manager as a performance fee for making a good investment. A lot of times, if you're a fund manager, what you try to do is you basically will charge fees for basically operating the fund or the syndicate, but most of your compensation is actually going to come from the investment doing really well. So the opposite holds true, where with the carry, if you invest $1 million and then the deal only returns 500,000 and you've lost money, you as the manager receive nothing in terms of carry because you've now returned the $500,000. It wasn't the $1 million you invested. So you get, even though you get a 20% carry of profits, you had no profits. So you as the fund manager, probably did a ton of work for what turned out to be no compensation. So it basically is aligning the incentive for the manager and the investors.
Great. Well, does anybody in the audience have any questions so far? If you want to post it, you can. If you want to unmute and ask it directly, you can as well. I'll give you guys a chance to see if anybody has any specific questions about syndication platforms or SPVs. And while you're thinking of the questions, one of the questions I have is, where do you go to post your deal for syndication? What are some of the platforms out there that people are using these days?
Yeah, so with Smart Capital specifically, our platform is used by the investment groups themselves. So a lot of times, so our clients are like 10 Capital or other angel groups that work with 10 Capital. But basically the idea is the angel group would open up their own white label portal, and then the angel group themselves would post the investment opportunity to their investor base. So it would be a selection of basically the managers themselves would select the companies, post them up, and then their investor base would invest. If you're a startup and you're looking to get, the syndicated or these investments from these groups, you would kind of either Google search or you would ask around, and you would find out where groups are in your basically either geography or your industry. And then what you would do is you would reach out to them, and then they would, put you through the process of getting syndication, which however they personally do it. Yeah.
Great. Well, you talked the other day about how many SPVs are being launched every quarter and is growing quite dramatically. Can you tell us more about the growth rates and the number of SPVs that are coming up?
Sure. So like we talked about yesterday, there's around 12,000 Form Ds filed for these type of investments. And that does include real estate, and that does include everything under the sun. And so those Form Ds, that's per quarter. And so that is a growing number. I still have my homework to do to find out the actual growth rate for quarter over quarter and year over year. So I haven't done that yet, but it is kind of astounding how much basically these LLC entities are being created to create group funding.
And what do you find is the impact of having an SPV on a cap table? What's the pros and what's the cons of an SPV, if there are any cons?
Sure. So there's a bunch of benefits. So if you're a startup and you're raising capital, you want the investors, the basically angels in your that are going to participate to be in an LLC. The reason why is instead of getting, if you're going to get 30 investors that are all individuals, instead of having to put all 30 on your cap table for the round, what ends up happening later on is that when you go and you raise your next round or future rounds, you oftentimes have to get sign-offs from previous investors. So when you do your next round, you have to notify them, say you're going to raise your next round. You have to get potential signatures for things like acquisitions or mergers or going public, anything like that. You're going to have to go and get basically signatures for things like that. So you're basically setting yourself up to herd a bunch of cats, is what the industry kind of calls it. So if you are putting 30 individuals on your own cap table, it's going to cause problems. Instead, if the 30 individuals go into the LLC, now there's going to be one point of contact, which is whoever's managing that LLC as the lead investor, as you mentioned earlier, Hall. And that person is going to be your person of contact going forward. So when you need signing of docs for raising future rounds or whatever, you have one person and one line item on your cap table, which keeps it cleaner than having a bunch of individuals that you're going to have to manage. On the opposite side, for the investors themselves, one of the reasons why going into an LLC is great is oftentimes when the startup does a raise, in order to protect their cap table, like we just talked about, they make a minimum. So the minimums range anywhere from 25K checks, and later rounds is kind of potentially over 200K. So if you're an investor that wants to invest 5, 10K, 20K into these startups, you only get that opportunity is if you go into an SPV or an LLC where you're pulling money from other investors. Because if you pull money, say from 30 investors and it's all 5K checks, well, that's still 150K, and that still will probably get you to meet minimums as well as potentially even get like information rights and other major purchaser type abilities. So as an investor, it actually helps you basically get in deals as well as get kind of some of the major purchaser perks.
Great. We had a few questions come in. The first one is, does Smart Capital invest in startups outside of Denver, outside of Colorado?
So to clarify, Smart Capital itself does not do the investing. The clients that we have using the platform are the groups that do the investing, and each group on the platform will invest in various different things. So I think part of that question was surrounding Denver Angels, which is one of the users of the platform. Denver Angels does invest primarily in Denver and greater Colorado companies, but there's multiple groups on the platform that invest in all kinds of things.
Great. And what's the geographical dispersion of those groups? How do they concentrate in one area? Are they spread out, or where do they cover, or any information about that?
Yeah, so I actually haven't ran that. That would be really interesting. I think it seems like a lot of the groups are, coastal. So you still have tons of people on the East and West Coast. It's been kind of interesting. You'll see pop-ups in the middle of the country. I've noticed that the Southeast is not. I haven't seen any groups specifically from Southeast other than one from Miami, which is kind of interesting. But I think if you kind of look at a map of the fastest growing cities for startups, I would assume a lot of the activities are around there.
Great. The next question is, do syndications primarily focus on geography, industries, or both? And does either geography or industry focus dominate? Even without looking at the numbers, what do you think the answer might be there?
I would say it's been interesting that geography is probably more so than industry. That's been kind of the trend I've seen. But at the same time, it just depends on what the group or the investors are interested in. So every group is going to have something that they kind of probably specialize in or they're excited about. And that kind of is what drives, the investor behavior. For a reminder, as a group, one of the things that's different than a fund is with a fund, you're going to have, central decision makers, probably anywhere between, 1 to 10 people are making the major decisions. With investment groups, each member of the group is going to basically make a decision to invest or not. The groups that are the highest functioning groups are usually come together with the common purpose for investing in some kind of thesis or theme. And that way, when a deal comes to the group, it's kind of aligned with the majority or at least a handful of the investors in the group. And so that only it doesn't really work if you have a bunch of fintech investors in the group and then you try to push through a life science deal. A lot of the fintech investors aren't going to know much about that deal and therefore potentially not participate. So it just is the group as a whole, it's going to be what the majority of the members are interested in.
Okay. And so what type of investors are picking up the syndication platform? Is it angel groups? Is it family offices? Is it funds? Is it individuals who are not associated with any network, they're just on their own or just their buddies? What do you see as the adoption rate there?
Sure. So right now it's been primarily angel groups or groups of investors that have been doing this kind of informally. We mentioned yesterday that, there's a handful of kind of like groups of 20-ish people that, meets the founder, takes them to like a bar, drinks with them, and then tries to invest individually. There's those type of investors. There's investors that have met each other through work or other that are on there. And then a lot of them are angel groups that, have been doing this model of direct investing where all their angels are trying to basically go and invest directly into the deal, that are now trying to do more formalized investment approach. We're also seeing some funds. Basically, they have their own fund and they have their investment thesis. But what they're also doing is creating these SPVs or these syndicates to allow their LPs basically to put in additional money into specific companies that they're excited about, as well as get investors that weren't potentially in the fund into some of the deals. And so it's kind of been a range of, people that have informally done this, angel groups that want to take this to the next level, and then VC funds that want to create what are called sidecar deals.
Great. So the next question is, what's the typical dollar range of capital raises through Denver Angels and other similar syndicates?
Yeah, so really with a syndicate, if you're not going to hit around at least 100K and then you should be targeting 200K, then it doesn't necessarily make sense to do SPVs, just because if it's only, 5 to 5-ish investors that are putting in, then it might make more sense for them to go into the deal individually. If you're going to do kind of this 200K plus syndication type thing each time, then it makes a ton of sense to do LLCs and SPVs. And so basically with you asked about Denver Angels. So Denver Angels average check size is around 500K to $1 million. And by the way, we can't ever share at Smart Capital, we can't ever share client data. The only reason I can share Denver Angels data is I'm a manager there. So I just want to highlight that real quick. We can't talk about other clients, but Denver Angels specifically is doing between $500,000 to $1 million checks. And then the range of investors that are participating in each syndicate is somewhere between 30 to 60. And so that's like a good model for using kind of syndication and investing. I would say the average is probably somewhere between 200 and 300K. And so that seems to be more standard. There are angel groups out there that are syndicating around 2-ish plus million for some of their side deals. So, or some of your main deals, and those are the individuals in the group are writing bigger checks, as well as there's a lot of participation. So.
Great. So I see a lot of deals coming from the angel world looking to raise funding or more funding, and now seeing more and more deals coming from the crowdfunding world, the Reg CF equity crowdfunding place. And one of the first questions I always get is, where do I get to put up my deal? Because in the crowdfunding world, there was a platform, you posted your deal up there. In the angel world, for the most part, there is no central place to post your deal for everyone to see, and have had interest in syndication platforms for the posting capability. Everything's in one place, all the updates are in one place, you drive everybody to that one page, and at heart, it can help simplify the gathering of funds from disparate groups, investors. Everybody's sending checks here and there. Well, instead, just have everybody log on and put it into one place. Are you seeing any interest there as far as maybe having startups just post their own deal onto a syndication platform and post it with the SPV that's behind it for the legal structure? Instead of the Title III legal structure, there's the SPV structure. What are your thoughts there?
Yeah, so AngelList is probably so just as a heads up, the AngelList came out in 2012-ish, and when they first started, that was kind of their model. It worked pretty well starting off, and then it kind of trailed off as of late. So there's no kind of like one central place to post and then just have a bunch of angels, invest. That's been a tough nut to crack. Something that we're doing at Smart Capital is, again, we target each individual, angel group and allow them to create their own portal. And so that does, require that, post in each one of the angel groups. At the same time, angel groups are very collaborative. And one of the things we want to keep building out is the ability for each individual investment group to be able to share deals with other angel groups and have them invest in the same SPV. As far as the individual companies being able to post something and then have a bunch of angels come in, that's not something we personally are focused on at Smart Capital. But at the same time, there's plenty of angel groups that could use or potentially take advantage of our platform to do that, and basically create their own large network of angels that, when they do post a deal, there's potentially thousands of angels in that network that are going to see that deal and potentially invest and they could potentially use our portal for something like that. The biggest thing though with angels, and you mentioned Reg CF in the kind of initial part of that, with angels and sophisticated investors, they're a lot more choosy about deals is what we've kind of noticed. Whereas the Reg CF platforms, there'll be more lax about what goes on there. They're also very marketing and hype driven, which to the general public or general, consumers that are investing in those type of things, that's what drives a lot of the investment. We notice with angels, they're a lot more thoughtful about stuff. They like to think things through. They each have niches. So that's what we were talking about earlier, is they have industry or geography niches. So this kind of mass appeal to angels is an interesting idea and an interesting problem, but I don't think anyone's really cracked the nut on that one yet.
Well, it used to be that the minimum investment in an angel group by an individual was $50,000. And then over the years, that kind of migrated down to about $25,000. And even today, I started getting questions from angels. Can I come in for 10 or can I come in for 5? And what I'm finding is that angels are spreading their money across more deals to find a hit. And instead of putting big dollars in on the first round, they're going to spread it around, and where 1 or 2 pop up, well, then they'll follow on fund with bigger dollars, 100, 150K check or something like that. Once you figure out where the winners are, because up front, it's very hard to figure out where the winners are. What are you seeing out there in the syndication? What are the average investments you see across the board that people are making?
Yeah, so I do have this number. So the average check for an angel using, in a group using Smart Capital platforms around 10K. A lot of groups are setting their minimum investment at 5K. We've noticed that by setting it at 5K, a lot more investors are going to participate in those type of deals. It is kind of interesting to what you're saying is part of the reason why groups are so great here. Is because you to your point, you used to have to write, if you wanted to invest in any deal, like one company, you'd have to write a 50K check, usually minimum. And most accredited investors, their net worth does range between 1 and like 10 million-ish, is the majority, right? But the problem is, like, if you keep writing 50K checks and do, trying to get a diversified portfolio of 20 companies, that's $1 million. So most do not want to do that. So what they end up doing, or what they had done prior to kind of syndication and smaller check sizes, is do 2 or 3 deals and just hope, something hits, which a lot of times it doesn't. In that sense, you do want to have a diversified portfolio. And so what we're finding is, when people are entering this asset class, one thing they do want to do is kind of spread the love, right? So 5, 10K checks into 20, 30 companies. We had that panel yesterday, and Doug is a great example of that. Doug is invested in, I think, something like, he's at 35, 36 companies. And having known Doug, like, his check size is probably between that 5 and 25 K range. He's not writing humongous checks into tons of companies. It's that more kind of like steady approach over time too. And that's the other thing is a lot of angels prior to group funding burned out. They wrote, they went through all the cash they basically had set aside for investing in 6 months to a year, and then never touched the asset class again for years until they had some kind of return or an additional influx of capital. Now we're seeing angels basically continuously doing deals over time because they can write smaller checks.
Great.
Going into these groups.
So the next question is, for a startup, what have you seen as the largest capital raised via syndication?
The largest raise I've seen for one of these investment groups is 1.6 million is the largest I've personally seen. But I've heard stories of 2 million plus. So
if you go higher,
that though. Yeah.
Yeah. Well, great. Well, to your point, I used to see investors coming in and they would set aside, say, 500K for startup investing. And with 10 investments, they would have basically 10 50K checks. Today, what I see coming into the room is people with 100K to invest, not 500. And trying to get back to 10 investments means they're now down at a series of 5 and 10K checks to put money in, at least on the first round. And then on the second round, they would go find more, but up front, they were just trying to deploy that. So it seems like it's really pushed the top down. And when I look at the crowdfunding world, the average investment there is about $500. In most cases, they're putting that in off their credit card. So people can afford to throw money at a lot more deals at that level. And in most cases, there's really not an asset allocation. They're not thinking about follow-on funding. It was just a one and done, and maybe we'll get lucky and something good will happen there. So, but in most cases, you have to think about trying to get 10 deals going, of which 1 or 2 are going to be really good, 1 or 2 are going to be okay, and the rest are never going to be anything. So you have to come at it from that angle. So you have to think about, how are people coming at it with the funding that they're bringing to the table. What do you see as the average investment allocation that people are coming in with today?
Yeah, so I'm seeing around 10 to 20% of someone's personal portfolio is kind of the thing I'm hearing. There was an article written, I just saw it on LinkedIn the other day, that someone was saying that personally they're recommending clients have 30% of their allocation into these like private companies, which I think personally is probably high. But the 10 to 20%, I think if you're excited about the asset class, if you've been around startups, if you are willing to spend the time there, then that makes a ton of sense to me. And then to your point, one other thing that I think is kind of a trend that has been really interesting is these groups. You were asking about, what's the largest check size? To give kind of a highlight real quick, a VC seed fund that's probably like a $10 million fund is going to invest in around 20 deals, and so they're writing somewhere between these 200 to 500K checks because they're reserving some of the money for dry powder. A lot of these, like some of these angel groups, are writing consistently 500K plus checks in each deal, which is more than the majority of seed funds that are out there. So one of the things that I don't know if this was going to be asked, but I just wanted to highlight is that these like fund managers that are managing these groups are basically investing more than what they would invest if they had a normal seed fund, which I find personally fascinating. This is the first time we've ever seen something like that. And then as individuals, this is, if you're going to invest in this stuff, investing as a group is by far the best way to do it. So
you see a lot of syndication platforms around industry focus. And what is that industry or sector focus? What is that sector?
So right now, I think we're going through a moment in clean tech and fintech. I just think those two things are the, bee's knees currently. I think life science last year or bioscience last year was a big thing, with the pandemic and all those things coming out. I think all this stuff kind of like fluctuates. I think right now, finance and fintech platforms are having a moment, the clean tech movement and all that's having a moment. But it's really kind of variable, and it just kind of changes, as it goes. So we'll see how it keeps going.
Great. Next question is, given your blockchain background, have you seen many blockchain or cryptocurrency startups raising capital via syndicates and or angel groups?
Well, yes. So it's actually kind of interesting with the kind of future of all this group funding. And this is, we're at this point right now, we're creating LLCs, we're funding through normal technology platforms. But I mean, Ethereum, right? The first major thing was the DAO. And that's what started a lot. That's what actually caused Ethereum and Ethereum Classic to split was the DAO. The DAO itself had raised over 150. So for those that don't know, the DAO was a funding mechanism. It basically created a group fund of $150 million, basically within the span of like 3 months. It seemed like overnight, a bunch of people pulled money together. And the way the fund worked is basically everyone in the fund would vote on what to invest in. The DAO got hacked, and that's actually what caused the reversal of the hacking. They lost something like $15-16 million from that DAO fund. And then the Ethereum community decided that that transaction of the hack should be reversed. That's what caused Ethereum to split, and basically Ethereum Classic was a bunch of people that didn't want the hack of Ethereum to be split. So Ethereum Classic split off because of that hack in the DAO. But the DAO was kind of this first idea of this like massive group funding, massive, decision making across group members. I think we're still really early in that all of this. I think we've seen Ethereum talking about fintech platforms or fintech things taking off in the last year. So I think as we continue to evolve things like Ethereum and blockchains and all that, make this group funding model even easier. I mean, we do get requests, and it's on our future roadmap to start accepting Bitcoin and ETH and converting it into US dollars. There are plenty of investors that want to basically, instead of wiring in money, right? When we group these checks, want to send in Bitcoin or send in ETH. So I think it starts kind of there. But yeah, I think this kind of idea of group funding is actually empowered by those technologies.
Great. Well, are there any other questions from the audience? Okay, here's one. Given the rise in oil prices in your Denver location, has there been some interest, at least most recently, in the oil and gas patch?
So, I mean, it's kind of interesting. Denver and Colorado in general has one of the major economies is the oil and gas. I personally focus on startups and things that are like progressing everything. So I personally haven't seen a ton of oil and gas deals, but I do know that's something that gets a lot of investment. One of the other partners at Denver Angels does a lot of oil and gas type investing. So not necessarily in the startup thing, but more about land and other things that are related to that.
Great. Any final questions from you guys about the syndication platform or the SPV? Maybe Paul, you want to tell a little bit about more detail. How exactly does the Smart Capital platform work? If somebody is putting their deal on there, what is it? What are the mechanisms there?
Sure. So we allow anyone with a group can go in and sign up for a free account, so you can get started. Basically, what it allows you to do for the free model allows you to basically showcase your deals. So you can go in and you can put in the information about the startups that you and your group want to potentially invest in. You can invite your investor group so they can view those deals, and then you can collect interest. You can do all that for free. So basically, you log in, you see the deal, you start collecting interest on the deal, and then once you get to this point where you're 50K or 100K of interest on the deal, you can actually go ahead and create a syndicate, is what we call it, and that will actually start the process of creating this LLC. You go through the new onboarding step processes that allow you to actually easily create the LLC. And then that part, once you form the entity and you start collecting investment, that part we do charge fees for. But basically you can go ahead and create the LLC, and then you can allow the investors to sign the investment docs and then wire in the money. So basically pull that capital into one LLC, and then you can then direct that investment into the actual company. And then close out the syndicate and then wait for the return, and then view, updates and stuff through the platform as you go. That was basically the whole product in like a 30-second minute description. So there's a lot of little things in there, but that's how it mainly works.
So can you outline the process and time frame for a deal moving through a syndicate? Is the time frame similar to moving through an early stage fund, or is it faster or slower?
So the one difference between this and a fund is a fund will do what's called a cap call. So a lot of times when the fund goes ahead and decides to do a deal, they'll either have already called the capital, and so then they'll go ahead and immediately invest, or they'll do a cap call where investors then have around 2 weeks to send in the money. With syndicates, they move slightly slower, just because when they put up a deal, right, the investors have to go in, decide to invest, and then basically sign docs and wire. The fastest syndicate I've ever seen is probably 2 weeks from like open to close. Some of the syndicates, the way they actually work is they basically, collect the initial amount. So there's investors that are excited about investing in the deal. They'll put it up, and then the initial investors will invest into the syndicate, but they'll actually leave it up over time. And as more investors, can come in and invest into the LLC and into the syndicate, and some have left it up for 3 to 4 months. And basically, it's a slow roll of collecting investors into the LLC over time, as opposed to all at once. So It just depends on the style of the and how the timeline of the company and the timeline of the managers. But you can move these actually now with the software pretty fast if you wanted to, which before things like Smart Capital and other platforms usually was the hard part, was basically manually pinging every investor, hey, can you sign these docs, hey, can you wire the money, hey, like constant updates and herding the cats, as we called it earlier. That would normally take a while. Now with a platform like this, you can actually move these really fast, which is cool. So
cool. Well, great. Well, 3 more questions. Go ahead and put them in now. Otherwise, we'll go ahead and start the wrap-up process. I want to thank you, Paul, for coming out and sharing that with us today. Do you have any final words or thoughts to people about the Smart Capital or syndication platforms or SPVs?
Nope, that's it. I'm really appreciative of you guys having me and asking the questions. I'm just thinking in general, group funding is gonna, it's having its start of its moment right now, I think, in the last few years. And I'm just pretty excited because, like we talked about earlier, you're seeing VCs use group funding and SPVs. And I think this hybrid model going forward is going to be one of the bigger trends that we see in venture and investing in startups and real estate and all these kind of different private investments. So it's going to be interesting.
Great. Well, if there are no more questions, we'll go ahead and wrap it up today. We want to thank everybody for coming out to ask great questions and listen to the presentation. I want to thank Paul for joining and sharing that with us today about syndication, as we're seeing it come more and more, and it becomes a bigger part of the funding world. And with that, we'll go ahead and close it out. I want to thank you guys for joining.
Awesome. Thank you, guys.
Thanks.